The declines that we saw in the fixed income market in the first quarter were some of the worst declines we've seen since the early 1980s. This was extremely disappointing for investors who have been accustomed to really getting at least some modest level of return in the fixed income markets. It was really a seismic shift in monetary policy as the Federal Reserve decided to completely change their stance on the inflation environment and reset the fixed income market to price in more aggressive rate hikes. There's no better example than to look at the moves we saw in short-term fixed income, in the short-term treasury yield. As you can see in this chart, it was the biggest basis point move in the 2-year yield that we've seen since 1984. Now, fixed income, we're not abandoning it altogether. We still think its sole purpose will be for portfolio diversification, but our stance has not changed as far as positioning. Defensive, short duration. It'll help to mitigate some of the losses in a rising rate environment. Floating rate instruments may be able to capture some of that, those higher yields as interest rates go higher. And as enticing as credit may be, because it is offering some extra yield, just be very careful. We're waiting to see that the reward is there for the risk that you're taking. There is still some concern that spreads are widening. They're still a little low from a historical standpoint, so we'd want to see credit get a little bit cheaper, but it may be an opportunity at some point this year to add in a defensive stance some extra yield in the portfolios.